Well, you can see the reaction by doing it the other way, dumping it, the reaction that it has. It's, oh my gosh. And to your point of fiscal irresponsibility, the U.S. government added $1 trillion to the debt in 71 days last month. 71 days from 37 to 38 trillion just recently. And the interest cost on the debt is mounting at a level where, it's now the largest budget item. And none of this includes the unfunded future liabilities, which are so large and disgusting that I don't know how you pay them off without devaluing the currency. Ultimately, that is how it has to be done, as far as I am concerned. But yeah, this is a deal where the shipments out of both the COMEX in New York, or the shipments into COMEX in New York, or out of, some of it stayed in there, roughly 38 million ounces this month of silver, and that will put it on pace to be one of the biggest delivery months ever. This is a deal where, at the same time, you have one of the largest short positions ever on SLV. Over 80 million shares are naked short. To affect this, there's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever, and at the same time, it's getting hammered. And SLV has an 84 million ounce short position, or share, 84 million shares. I guess I don't know if that's ounces or shares. For the last, it's 83.86 million, represents 15% of all outstanding shares. So I guess it's shares. So the shares are being driven down, which affects the price, but yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month. It's a very interesting, hard to decipher market. But when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. And at the same time, when you look at, them shorting SLV, it's much more difficult to point fingers at who's doing it when it's not done directly through the COMEX. And you should never be able to grotesquely short, as Ed Steer says, a proxy like SLV, but it certainly has its impact on the price. And again, think about this. We added $1 trillion in 71 days. That's just unheard of, and it's unsustainable. And our debt is rapidly approaching 130% debt to GDP, where other than Japan, no one's ever come back from that. And, the difference with Japan is that, they're not the world reserve currency. They have a budget surplus, and their debt not only is contained with yield curve control, it's mostly owned by the hedge funds, the government, and the people. And so they can get away with it. We can't. And if you're holding treasuries and you see the fiscal irresponsibility mounting, and that's why you're seeing, as an example, China building its own financial plumbing to get around the U.S. dollar system because it's no longer trusted. And, we focused a lot on Enbridge, but the CIPS system, the cross-border interbank payment system, which is China's version of SWIFT, is, in my opinion, the rails to what the Enbridge system will be. It's over 185 countries already are using CIPS to settle, including the Asian countries, which we've talked about before, which are 35% of global GDP right now, and China's biggest trading partner, twice the population of the United States. But the kicker is that once countries accept payment in yuan, like Russia sells oil or Brazil sells soybeans, they don't have to just sit on stacks of Chinese yuan. The Shanghai Gold Exchange, those yuan balances are actually convertible into gold. And this means that exporters who don't want to hold yuan can take that money and they've earned and go right to the Shanghai Exchange and convert it into gold bars. It's effectively a yuan to gold backdoor, and the vault, as we talked about, is being built in Saudi Arabia. And this is why you'll hear analysts talk about this petro-yuan to gold trade. Instead of taking dollars for any commodity, the yuan is now convertible into gold. It's not backed by gold, but it is immediately convertible into gold. In essence, the system is finding an alternative to the dollar-based system, which since 1971 has only been backed by trust and confidence. And you can see that that's slipping on many levels. And so I do think that this is the underlying reality that isn't getting better, nor is our fiscal responsibility. We are at 123% debt to GDP. Most of my career, any country at 100% would be considered a banana republic. And in 71 days, we at 100 billion a week. How long can that go on? I think people need to think about this, and maybe this is why you're seeing big money start to move into gold. The central banks have been front-running it, and now you see Bank of America, Jefferies, Morgan Stanley, JP Morgan. They're all saying they're reassessing their outlook on gold all the way up to 25%. And when you see Michael, or big bond trader, the bond king for BlackRock, the Jeffrey Gundlach, say a 25% allocation to gold is not overweight. I mean, that's just unheard of to say that. Look, the deliveries off of COMEX, to me, really more than anything, are telling you that the most sophisticated traders in the West feel the same way. And if they're going to knock the paper price down, well, they'll cover their shorts and they'll stand for delivery. And we're seeing that. It's an emotional thing to see price fall the way that it did, but it is really done in a very irrational way that isn't being reported, and they're dumping it in a matter specifically to affect that type of sentiment and that type of aggravation.
Well, you can see what happens when they do it. Every time we watch this pattern unfold, dump a mountain of paper contracts into the market at 2 a.m., when liquidity is at its thinnest, the reaction is the same. Prices collapse in seconds, algorithms trip, retail investors panic, and mainstream pundits rush to tell you gold and silver broke down. And yet, behind the curtain, something completely different is happening. The smartest, most well-capitalized players in the world are quietly buying everything they can get their hands on. Let's just step back and look at this madness logically. The US government added $1 trillion to the national debt in 71 days. That's not hyperbole, it's math. 71 days to go from $37 trillion to $38 trillion. You can almost hear the printing presses gasping for air. And the interest cost on that mountain of debt? It's now the largest budget item in the federal ledger. More than defense, more than Social Security, more than Medicare. Think about that. We are now paying interest on our past stupidity with borrowed money at interest. And remember, that's just the bonded debt. It doesn't include unfunded liabilities. All the promises the government has made to future retirees, veterans, and healthcare recipients. Add those in, and you're north of $100 trillion, maybe more. There's no way to pay that off with sound money. The only path out, the one that every empire has eventually chosen, is debasement. You destroy the currency quietly, inflate away the debt, and pray the public doesn't notice until it's too late. That's why I laugh when people ask if this is temporary. This is the plan. And that's why I say gold and silver aren't investments. They're life rafts. But here's the crazy part. While this financial Titanic is sinking, the bullion markets are flashing signals of unprecedented strain. Look at the COMEX. We're on pace for one of the biggest silver delivery months ever. Roughly 38 million ounces already delivered this month, and that's before month-end settlements. That's not small stuff. That's sovereign-level accumulation. Now overlay that with the fact that we're seeing one of the largest short positions ever recorded on SLV, the Big Silver ETF. Over 83 million shares shorted, representing about 15% of all outstanding shares. That's the biggest short position since the silver squeeze days of 2021, and it's happening right as physical deliveries are exploding. So on one hand, you've got massive paper selling. On the other, massive physical buying. Which side do you think wins in the long run? The one holding IOUs or the one holding ounces? This is the essence of what's really going on, a tug of war between perception and reality. The perception is created in the paper markets, the COMEX, the LBMA, the ETFs like SLV, where leverage can suppress price. The reality is expressed in the physical markets, where metal either exists or it doesn't. And lately, reality is fighting back. The irony is that while silver is being hammered on the screen, physical demand is off the charts. Dealers are reporting record orders, central banks are setting new purchase records, and refiners are booked months out. Meanwhile, the paper price, the spot price everyone quotes, is being driven lower by massive naked shorting. And it's not just speculation, it's strategic. This kind of coordinated shorting serves two purposes. One, to manage perception and prevent gold and silver from signaling panic. And two, to allow the largest players to accumulate metal quietly on the cheap. Now imagine the psychology here. You're watching the news and all you hear is gold crashes, silver tumbles, investors flee safe havens. You feel discouraged. You think maybe it's time to sell. Meanwhile, at the exact same moment, deliveries are being made in record size, and the big banks are loading up. It's like a magician showing you one hand while the other picks your pocket. And the fingerprints are all over the scene. Every time the price dumps, you can trace it to the same low liquidity window, after New York closes, before Asia opens, when no rational trader would ever sell huge quantities. Then right after that price collapse, you see massive physical delivery contracts being issued.
Here we are on Monday, and I won't know until tomorrow or later tonight what has precipitated this last pullback. We'll talk about last week's pullback in a moment and some of the things that I found interesting about it. But I mean, look, first and foremost, the long-term case for gold and silver is crystal clear, as far as I'm concerned. You have central banks, foreign governments will continue to buy gold and silver now, unless there is a fundamental change in the attitude of this country, in particular Congress, towards the U.S. budget deficit and the nonstop continued deterioration in our fiscal condition and our fiscal sanity. Our fiscal irresponsibility is off the charts. And you can see that by the continued shutdown of the government. And I think there'll be volatility. Look, this is a game where, largely because a lot of things that we've been talking about since 2020, when I started talking to you about the deliveries that we saw, those were the beginning signs of a system that is all about paper promises, rehypothecated paper promises coming unraveled, where countries and sovereign wealth funds and very plugged-in individuals and groups realize that it is indeed the Achilles heel of the entire system. And they would rather, I think, slowly exploit the metal and the commodities out of the system before there is a mad dash for them. And you know, a lot of people in this country, instant gratification isn't fast enough, and we've seen that with the rise and proliferation of cryptocurrencies and stocks like Nvidia and Apple that have defied gravity. One would say, well, why don't they just come in and buy it all up? And because you would see the strains that we're seeing right now in the LBMA, you would have seen them blow up instantly. And so this is something that is not only coordinated, but also methodical, very well thought out, and done so little by little. But I think that when you see the stuff that's going on, where in October already, almost 39 million ounces of silver have been delivered to the COMEX. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the COMEX is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on COMEX will do so on the first day notice. But what we have been seeing is deliveries, like in gold, that are 93% higher for the month than posted on the first day. This is contracts that are bought during the delivery month that instantly deliver, and they're much more difficult to analyze when you're trying to look at the Commitment of Traders report. But it's also very bullish in my mind. And as an example, between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records for this point in the delivery period.
This yuan to gold linkage is revolutionary. It's not a gold-backed currency, not officially, but it's effectively a convertible system that lets trade partners bypass the dollar entirely. And now Saudi Arabia is building a new gold vault as part of its integration with that system. That's not random. That's the foundation of a new financial order being laid right in front of us. For over 50 years, the dollar has been backed by nothing but confidence. Confidence in U.S. fiscal policy, in its rule of law, and in its economic dominance. But that confidence is evaporating. When you add $1 trillion of debt every 70 days, when your interest expense is higher than your defense budget, and when your central bank is trapped between inflation and insolvency, what's left to believe in? Other nations see this, and they're adapting. China and Russia aren't trying to destroy the dollar. They're trying to insulate themselves from its collapse. They're building their own payment rails, their own clearing systems, and their own mechanisms to settle trade in hard assets instead of promises. And here's where it all comes full circle. Gold is the bridge between the old world and the new. Western investors still think of gold as a trade. Eastern economies think of it as money. When a Chinese importer settles in yuan and converts that into gold, they're not speculating. They're preserving value. And that shift in mindset, from speculation to preservation, is what ultimately changes the system. Now let's go back to the domestic side for a moment, because the U.S. fiscal picture is deteriorating so rapidly it almost defies belief. We're spending $100 billion a week we don't have. That's banana republic behavior. Historically, any nation with a debt-to-GDP ratio above 100% is considered financially unstable. We're at 123%, heading for 130%. No major reserve currency in history has survived that without a reset. Japan's often cited as the exception, but Japan's situation is totally different. Their debt is domestically owned, their savings rate is high, and their currency isn't the global reserve standard. Plus, they run a trade surplus. The U.S. doesn't have any of those advantages. Our debt is held abroad, our savings rate is near zero, and we run massive trade deficits. We can't hide from this. So when foreign holders like China see that kind of fiscal recklessness, they respond rationally. They diversify. They build their own financial plumbing. They connect their CIPS system with gold convertibility, and they build trust with trade partners who no longer want to rely on the dollar. The U.S., meanwhile, keeps doubling down on arrogance, weaponizing the dollar through sanctions, freezing foreign reserves, and pretending that nothing will change. But everything is changing. This is why you're seeing gold deliveries surge, why you're seeing central banks buy record amounts, and why you're seeing Western banks, who've mocked gold for decades, suddenly reposition. They're not stupid. They see the same writing on the wall. Even legendary bond managers are saying it now. Jeffrey Gundlach, the bond king of double line, recently said a 25% gold allocation is not overweight. Think about that. For decades, conventional finance said a 5% allocation was conservative and 10% was aggressive. Now the bond king himself says 25% is reasonable. The ground is shifting under Wall Street's feet. When you combine that with record central bank purchases, over 1,000 tons last year, you start to realize that gold isn't just a hedge anymore. It's becoming the backbone of a new settlement network. Meanwhile, back in the West, we're witnessing the mirror image, a system drowning in paper promises. The U.S. Mint can't even keep up with physical demand for silver eagles. Dealers are rationing inventory. Industrial users are warning about supply tightness. Yet somehow the price keeps dropping because hedge funds are shorting ETFs, like SLV, by the tens of millions of shares. That's not market efficiency, that's desperation. It's an attempt to suppress the signal, to keep confidence alive for one more quarter, one more earnings season, one more election cycle. But the dam is cracking. You can't short reality forever. And that's what makes this moment so fascinating. Every metric that matters, deliveries, inventory drains, central bank demand, currency diversification, is flashing bullish. And yet sentiment is cautious. That's exactly what major transitions look like. They start with disbelief. People keep asking, Andy, when does the reset happen? When does gold go to $5,000 or $10,000? My answer is simple. It's already happening. It's not going to be a single event where the screen flashes and everything revalues overnight. It's a process. It's death by 1,000 paper cuts. You're living through it right now. Every time the Treasury auctions go poorly, every time the Fed talks about cutting rates while inflation's still sticky, every time China converts yuan into gold instead of dollars, that's part of the reset. And when it accelerates, it'll look sudden, but it won't be. It'll just be the moment the world finally notices what's been happening quietly for years. This is why I tell people, stop thinking in terms of dollar price. Don't measure gold in dollars, measure dollars in gold, because the dollar is what's changing. Gold isn't moving, it's the yardstick. It's everything else that's shrinking. If you own physical gold or silver, you're not betting on volatility. You're opting out of insanity. You're stepping off the hamster wheel of devaluation and saying, I'd rather hold something that doesn't need a central banker's promise to have value. And yeah, I get it. Watching prices fall on a screen hurts. It's emotional. It feels irrational. But that's the point. It is irrational. They dump contracts at midnight for one reason, to manipulate sentiment. They know most investors can't stomach short-term pain. They want you demoralized, because every ounce you sell is an ounce they can buy. So here's my advice. Zoom out. Look at the big picture. Look at what the world's largest players are doing, not what the headlines are saying. The governments, the sovereign funds, the mega banks, they're all converging on the same strategy. Get out of paper, get into metal. When history books are written about this era, they'll talk about how the global monetary system quietly transitioned from dollar hegemony to a multipolar, asset-backed framework. And the people who understood it early, who accumulated real metal instead of chasing digital illusions, will be the ones who preserve their wealth. So as we watch another orchestrated sell-off and another round of headlines about gold weakness, remember, this is the noise before the breakout. This is the accumulation phase before the revaluation. And when it finally happens, when gold breaks free from paper control and reprices to reflect reality, it'll happen fast, faster than anyone expects. Until then, every dip is a gift. The question isn't when gold will rise, it's whether you'll have any left to buy when it does.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.